filing status and personal exemptions, standard versus itemized deductions, gross income and exclusions, wage and salary income, W-2, interest and dividend income, capital gains and losses, IRA contributions and distributions, Social Security and Medicare tax, tax credits, child tax credit, EITC education credits, estimated tax payments and withholding, intermediate/individual, rental income and expenses, self-employment tax, Schedule SC, home office deduction, depreciation, MACRS, Section 179 bonus, passive activity loss rules, alternative minimum tax, AMT, net investment income tax, NIIT, qualified business income deduction, Section 199A, health savings accounts, HSAs, casualty and theft losses, alimony, pre- and post-2019 rules, education savings, 529 plans, Coverdell, adoption credits and exclusions, foreign earned income exclusion, Section 911, business taxation, business entity selection, sole prop, partnership, S-corp, C-corp, partnership taxation, Form 1065, K-1s, S-corporation rules, Form 1120S, reasonable compensation, C-corporation taxation, Form 1120, double taxation, payroll tax compliance and trust fund taxes, business startup and organizational costs, inventory methods, FIFO, LIFO, weighted average, accounting methods, cash fees accrual, Section 481 adjustments, like-kind exchanges, Section 1031, installment sales, Section 453, net operating losses, NOLs, employee versus independent contractor classification, fringe benefits and taxability, retirement plans, SEP, simple 401k defined benefit, estimated tax for businesses, representation and ethics, Circular 230, duties and restrictions, power of attorney, Form 2848, tax information authorization, Form 8821, IRS audit examination process, IRS appeals process, collection procedures, liens, levies, seizures, offer in compromise, installment agreements, innocent spouse relief, statute of limitations, assessment and collection, penalties, accuracy-related, fraud, failure to file pay, taxpayer bill of rights, practitioner penalties under Sections 6694-6695, CAF, Centralized Authorization File System, Advanced/Specialized, Estate and Gift Tax Fundamentals, Trust and Fiduciary Income Tax, Form 1041, Cancellation of Debt Income, Form 1099-C, Insolvency, Hobby Loss Rules, Section 183, ATRISC Rules, Section 465, Related Party Transaction Rules, Constructive Ownership Rules, Accumulated Earnings Tax, Personal Holding Company Tax, Section 1244, Small Business Stock Losses, Qualified Small Business Stock, Section 1202, Tax-exempt organizations, Section 501C, 3, Unrelated Business Income Tax, UBIT, Excess Business Loss Limitations, Obscure/niche, Section 280A, Vacation Home/dwelling Unit Rules, Golden Parachute Payments, Section 280G, Below Market Loans, Section 7872, Kitty Tax, Section 1G, Section 1245 versus 1250 Recapture, Uniform Capitalization Rules, Section 263A, Involuntary Conversions, Section 1033, Tax Benefit Rule, Section 111, Claim of Right Doctrine, Section 1341, Assignment of Income Doctrine, Substance over Form/Step Transaction Doctrine, Economic Substance Doctrine. Section 6751. B. Supervisory approval of penalties. Transferee liability. Section 6901. Jeopardy assessments. Bankruptcy and tax claims priority. Community property rules and tax context. Foreign account reporting. FBAR/FATCA. Expatriation tax. Section 877A. Section 83B. Elections for restricted property. Income. Gross income. IRC Section 61. Gross income. IRC Section 61. Internal Revenue Code Section 61 defines gross income as all income from whatever source derived. This is intentionally broad. The Supreme Court in Commissioner v. Glenshaw Glass clarified that gross income includes undeniable accession to wealth, clearly realized, over which the taxpayer has complete dominion. If those three elements exist, the amount is gross income unless a specific exclusion applies. Core principle. Gross income is the starting point of the individual tax calculation. Tax formula framework. Gross income. Adjustments, above-the-line deductions, equals adjusted gross income, AGI. Standard or itemized deduction equals taxable income. Everything begins with Section 61. Major categories listed in Section 61. The Code provides examples, not an exhaustive list. Compensation for services, wages, salaries, commissions, bonuses, tips, fringe benefits. Business income. Gains from property dealings. Interest. Dividends. Rents. Royalties. Alimony for pre-2019 divorce instruments. Annuities. Pensions. Income from life insurance contracts. Income from discharge of indebtedness. Partnership income. Estate or trust income. The phrase including but not limited to is key. The list is illustrative, not limiting. Realization requirement. Income must generally be realized to be taxed. Examples. Appreciation in stock value is not taxable until sold. Receiving cash, property, or services is realization. No realization equals no income, unless specific statutory rule says otherwise. Form of income does not matter. Income may be cash, property taxed at FMV, services received, barter exchanges, cryptocurrency, illegal income, prizes and awards, punitive damages. All are taxable unless excluded. Key inclusions frequently tested. 1. Compensation. All wages are gross income. Tips over $20 a month must be reported. Non-cash compensation is included at FMV. 2. Interest. Bank interest is taxable. Tax-exempt municipal bond interest is excluded, but still affects certain calculations like Social Security taxation. 3. Dividends. Ordinary dividends taxed at ordinary rates. Qualified dividends taxed at capital gain rates. 4. Capital gains. Gain equals amount realized, adjusted basis. Only realized gains are income. Holding period determines tax rate. 5. Cancellation of debt COD. Forgiven debt is income unless excluded under IRC Section 108, bankruptcy, insolvency, etc. 6. Social Security. Not fully taxable. Taxability determined under IRC Section 86 using combined income formula. Constructive receipt doctrine. Income is taxable when it is credited to your account, set apart for you, or made available without restriction. You cannot defer tax simply by refusing to take possession. Example. A bonus available in December but picked up in January is still December income if available without restriction. Assignment of income doctrine. Income is taxed to the person who earned it, even if assigned to someone else. You cannot shift tax liability by redirecting payment. Illegal income. Illegal income, theft, drug sales, embezzlement, is taxable under Section 61. The source of income does not matter. Exclusions, very important. Gross income includes everything unless specifically excluded by statute. Common exclusions, not part of Section 61 itself, but elsewhere in the Code. Gifts, Section 102. Inheritances. Life insurance proceeds, generally. Certain scholarships. Employer-provided health insurance. Qualified fringe benefits. Municipal bond interest. Exam concept. Income is included by default. Exclusion must be proven. Timing. Cash method taxpayers. Income included when actually or constructively received. Accrual method. Income included when earned and determinable. Most individuals are cash method. Common exam traps. Forgetting small income sources. 1099 INT, 1099 div. Thinking gifts received are taxable. They are not. Confusing loan proceeds, not income with debt forgiveness, income. Believing appreciation is income before sale. Misclassifying return of capital as income. Strategic importance for enrolled agents. As an EA, you must identify every accession to wealth. Confirm realization. Check for applicable exclusions. Verify reporting forms, W-2, 1099 series. Understand how gross income flows into AGI and credit phase-outs. Everything downstream, deductions, credits, NIIT, AMT, depends on proper gross income determination. One-sentence master definition. Gross income under IRC Section 61 is all realized accessions to wealth over which the taxpayer has dominion from whatever source derived, unless specifically excluded by statute. If you want, I can now give you a compressed 3-minute audio script version, a flashcard drill set, or a gross income exam traps rapid review sheet for repetition. Which format do you want next? Okay, do it in a paragraph that I can copy and paste into 11 Labs. Here is a tight, audio-ready paragraph you can paste directly into 11 Labs. Gross income under Internal Revenue Code Section 61 is defined as all income from whatever source derived, and it serves as the starting point for calculating federal income tax. The Supreme Court in Commissioner v. Glenshaw Glass clarified that gross income includes any undeniable accession to wealth that is clearly realized and over which the taxpayer has complete dominion. In practical terms, this means if a taxpayer receives cash, property, services, or any economic benefit, and no specific exclusion applies, it is gross income. The Code provides examples such as wages, salaries, tips, business income, rents, interest, dividends, capital gains, alimony for pre-2019 divorce agreements, pensions, annuities, partnership income, and cancellation of debt income. But the list is not exhaustive. Income must generally be realized to be taxable, meaning appreciation alone is not taxed until there is a sale or disposition. The form of income does not matter. Cash, bartered goods, cryptocurrency, prizes, and even illegal income are included. Under the constructive receipt doctrine, income is taxable when it is made available without restriction, even if not physically received. Under the assignment of income doctrine, income is taxed to the person who earned it, even if it is redirected to someone else. Gross income includes everything unless Congress specifically excludes it elsewhere in the Code, such as gifts, inheritances, certain life insurance proceeds, qualified scholarships, municipal bond interest, or employer-provided health insurance. Because gross income flows into adjusted gross income and ultimately determines deductions, credits, phase-outs, net investment income tax, and alternative minimum tax exposure, accurate identification of gross income is foundational to proper tax analysis and compliance. Wages, salaries, tips. Wages, salaries, and tips, detailed summary. Core definition. Wages, salaries, and tips are forms of compensation for services and are included in gross income under IRC Section 61. A.1. Compensation includes all remuneration for services performed, unless specifically excluded by statute. Wages. Typically hourly pay. Reported on Form W-2. Subject to federal income tax withholding, Social Security tax, Medicare tax, federal unemployment tax, employer. Includes regular hourly earnings, overtime pay, bonuses, commissions, severance pay, back pay awards, salaries, fixed annual compensation paid periodically. Also reported on Form W-2. Treated identically to wages for tax purposes. Withholding rules are the same. Tips. Cash tips. Charged tips. Tip-sharing arrangements. Non-cash tips, property, tickets, etc. Key rules. Employees must report tips of $20 or more per month to their employer. Employer includes reported tips on Form W-2. Unreported tips are still taxable. Employee is responsible for Social Security and Medicare tax on tips. Fringe benefits, frequently tested. Compensation includes non-cash benefits unless excluded. Taxable fringe examples. Bonuses. Personal use of company car. Awards not meeting exclusion rules. Excess group term life insurance, over $50,000. Common exclusions, not wages if qualified. Employer-provided health insurance. Certain educational assistance. Qualified transportation benefits, within limits. De minimis fringe benefits. Timing. Cash basis taxpayers, most individuals. Income included, when received or constructively received. Constructive receipt. Taxable, when made available without restriction. Social Security and Medicare implications. Wages and tips are subject to 6.2% Social Security, up to wage base limit. 1.45% Medicare, no cap. Additional 0.9% Medicare tax above thresholds. What is not wages? Gifts from employer, rare, usually treated as compensation. Qualified reimbursements under accountable plans. Certain employee discounts. Qualified fringe benefits. Common EA exam traps. Forgetting to include unreported tips. Confusing accountable versus non-accountable reimbursement plans. Treating employer gifts as tax-free when they are compensation. Forgetting that non-cash compensation is included at FMV. Misunderstanding additional Medicare tax thresholds. Strategic importance. Wages, salaries, and tips form the primary income source for most taxpayers. Drive AGI. Affect phase-outs for credits. Trigger payroll taxes. Impact EITC eligibility. 11 Labs Ready paragraph version. Wages, salaries, and tips are forms of compensation for services and are included in gross income under Internal Revenue Code Section 61, subsection A1. Compensation includes all remuneration for services performed unless a specific exclusion applies. Wages typically refer to hourly pay and salaries refer to fixed annual pay, but for tax purposes they are treated the same and are reported on Form W-2. They are subject to federal income tax withholding, Social Security tax, and Medicare tax. Compensation also includes bonuses, commissions, severance pay, back pay, and non-cash benefits received in exchange for services. Tips, whether cash, charged, or non-cash, are fully taxable. Employees must report tips of $20 or more per month to their employer, but even unreported tips are still taxable income and subject to payroll taxes. Non-cash compensation is included at its fair market value. Under the constructive receipt doctrine, wages are taxable when made available without restriction, even if not physically in hand. Certain fringe benefits may be excluded if they meet specific statutory requirements, such as employer-provided health insurance, But absent an exclusion, all compensation for services is included in gross income and forms the foundation of most individual tax calculations. Interest income. Interest income, detailed summary. Core definition. Interest income is included in gross income under IRC Section 61A. 4. Interest is compensation for the use or forbearance of money. If a taxpayer lends money or deposits funds and earns interest, it is taxable unless specifically excluded. Common sources of taxable interest. Bank savings accounts. Checking accounts, interest-bearing. Certificates of deposit, CDs. Corporate bonds. U.S. Treasury bonds and notes. Private loans. Installment sales interest. Promissory notes. Reported on Form 1099 INT. Tax-exempt interest. Certain interest is excluded from federal gross income. Municipal bond interest, state and local bonds. Important. Although excluded from federal income tax, tax-exempt interest may still affect Social Security taxation, affect phase-outs and credit calculations, be taxable at the state level, depending on jurisdiction. Tax-exempt interest is reported, but not included in taxable income. U.S. government obligations. Interest on U.S. Treasury obligations is taxable federally, often exempt from state income tax. Accrual of interest. Cash method taxpayers. Interest is taxable when received or constructively received. Accrual method taxpayers. Interest is included when earned. Most individuals are cash method. Original issue discount, OID. OID occurs when a bond is issued below face value. The discount is treated as interest income. Must be included annually as it accrues. Reported on Form 1099 OID. Common EA test topic. Imputed interest rules. If a loan is made below market rate, the IRS may impute interest under IRC Section 7872. The lender must report interest, income, even if none is actually received. Applies to family loans, employer loans, corporation shareholder loans, constructive receipt. Interest is taxable when credited to an account, made available without restriction, even if not withdrawn. Example: bank credits interest December 30, one right arrow taxable that year. Accrued interest on bond sales. When a bond is sold between interest dates, seller reports accrued interest received as interest income. Buyer adjusts basis accordingly. Common EA exam traps. Forgetting small 1099 INT amounts. Confusing municipal bond interest treatment. Missing OID income. Ignoring imputed interest rules. Thinking reinvested interest is not taxable, it is taxable. Strategic importance. Interest income. Increases AGI. Impacts Social Security taxation. Impacts NIIT calculation. Affects credit phase-outs. Frequently appears on exams because it seems simple but has technical rules. 11 Labs Ready paragraph version. Interest income is included in gross income under Internal Revenue Code Section 61, subsection of 4, and represents compensation for the use or forbearance of money. Taxable interest commonly arises from bank accounts, certificates of deposit, corporate bonds, U.S. Treasury obligations, private loans, and installment sales, and is typically reported on Form 1099-INT. Cash method taxpayers include interest when it is received or constructively received, meaning when it is credited or made available without restriction, even if not withdrawn. Municipal bond interest is generally excluded from federal gross income, but may still affect calculations such as Social Security taxation and certain credit phase-outs. Original issue discount, or OID, must be included annually as it accrues, even if no cash is received, and below-market loans may trigger imputed interest under Internal Revenue Code Section 7872, requiring interest to be reported even when none is actually paid. Reinvested interest remains taxable, and accrued interest received upon bond sale must also be reported. Unless specifically excluded by statute, all interest income is included in gross income and contributes to adjusted gross income and downstream tax calculations. Dividend income. Dividend income, detailed summary. Core definition. Dividend income is included in gross income under IRC Section 61A, 7. A dividend is a distribution of property made by a corporation to its shareholders out of its earnings and profits. Dividends represent a return on equity investment. Types of dividends. 1. Ordinary dividends. Taxed at ordinary income rates. Reported in Box 1 of Form 1099 Div. Default classification, unless qualified rules are met. 2. Qualified dividends. Taxed at long-term capital gain rates, 0%, 15%, or 20%. Reported in Box 1B of Form 1099 Div. Must meet. Holding period requirement. Paid by U.S. corporation or qualified foreign corporation. Not specifically excluded, e.g., REIT dividends generally not qualified. Holding period rule. Stock must be held more than 60 days during the 121-day period surrounding the ex-dividend date. Common exam trap. Corporate earnings and profits, E&P. Dividends are paid from current earnings and profits, accumulated earnings and profits. If no E&P. Distribution is a return of capital, reduces basis. Excess over basis becomes capital gain. Very testable concept. Return of capital. Not dividend income. Reduces shareholders' basis. Taxed only when basis reaches 0. Then treated as capital gain. Capital gain distributions. Mutual funds may distribute capital gains. Reported separately on Form 1099 Div. Taxed at capital gain rates. Stock dividends. Generally not taxable unless shareholder can elect cash instead. Distribution changes ownership percentages. Constructive receipt. Dividends are taxable when paid or credited to shareholder, even if reinvested under DRIP, Dividend Reinvestment Plan. Reinvested dividends are still taxable. Special dividends. Liquidating distributions, treated as sale of stock, capital gain loss. S-corporation distributions, usually not dividends, flow-through income rules apply. NIIT impact. Dividend income is included in net investment income. May be subject to 3.8% NIIT if income exceeds thresholds. Common EA exam traps. Confusing qualified versus ordinary dividends. Ignoring holding period requirement. Forgetting return of capital reduces basis. Thinking reinvested dividends are not taxable. Misclassifying mutual fund capital gain distributions. Strategic importance. Dividend income. Affects AGI. Affects NIIT. Affects Social Security taxation. Interacts with capital gain tax brackets. Often tested because of holding period nuance. 11 Labs Ready paragraph version. Dividend income is included in gross income under Internal Revenue Code Section 61, subsection A7, and represents a distribution of property by a corporation to its shareholders out of its earnings and profits. Dividends are generally classified as either ordinary or qualified. Ordinary dividends are taxed at regular income tax rates, while qualified dividends are taxed at long-term capital gain rates of 0%, 15%, or 20%, provided specific requirements are met, including a holding period of more than 60 days during the 121-day period surrounding the ex-dividend date and payment by a qualifying domestic or foreign corporation. Dividends are reported on Form 1099-DIV, and reinvested dividends remain taxable even if no cash is received. If a corporation lacks sufficient earnings and profits, distributions may be treated as return of capital, which reduces the shareholder's basis, and any excess over basis becomes capital gain. Mutual fund capital gain distributions are taxed at capital gain rates regardless of holding period. Dividend income is also included in net investment income for purposes of the 3.8% net investment income tax when applicable. Unless specifically excluded by statute, dividend distributions constitute gross income and impact adjusted gross income and overall tax liability. Capital gains and losses. Core definition. Capital gains and losses arise from the sale or exchange of a capital asset under IRC Section 1221. Gain or loss is determined under IRC Section 1001. Gain equals amount realized, adjusted basis. What is a capital asset? A capital asset is broadly defined as property held by the taxpayer, except inventory, accounts receivable, depreciable business property, Section 1231 property, real property used in trade or business, copyrights created by taxpayer. Most personal investment property is capital. Stocks, bonds, personal residence, land held for investment, cryptocurrency treated as property. Basis. Basis is generally the cost of the property. Adjusted basis equals original cost. Improvements. Depreciation. Return of capital. Basis is critical for determining gain or loss. Amount realized. Amount realized includes cash received, fair market value of property received, relief of liabilities, selling expenses reduce amount realized, holding period, determines tax rate, short term, held 1 year or less right arrow taxed at ordinary rates, long term, held more than 1 year taxed at 0%, 15%, or 20%. Holding period begins the day after acquisition. Netting rules vary tested. Net short-term gains and losses. Net long-term gains and losses. Net short-term result against long-term result. If overall net gain. Character depends on final net. If overall net loss. Deduct up to $3,000 per year, $1,500 MFS. Excess carried forward indefinitely. Capital loss limit. Individuals. $3,000 annual limit against ordinary income. Remaining losses carried forward. Common EA exam point. Section 121, Home Sale Exclusion. Taxpayer may exclude $250,000, single. $500,000, MFJ. Requirements. Owned and used as principal residence for 2 of last 5 years. Very frequently tested. Special rates. Long-term capital gains rates depend on taxable income. 0%, 15%, 20%. High earners may also owe 3.8% net investment income tax. Wash sale rule. Loss is disallowed if substantially identical stock is purchased within 30 days before or after sale. Disallowed loss is added to basis of new stock. Highly testable. Like-kind exchanges, Section 1031. Applies only to real property held for business or investment. Gain deferred, not eliminated. Cryptocurrency. Treated as property. Each sale or exchange triggers capital gain or loss. Common EA exam traps. Forgetting $3,000 loss limit. Confusing short-term versus long-term treatment. Ignoring wash sale rules. Forgetting home sale exclusion requirements. Miscalculating basis. Forgetting liability relief increases amount realized. Strategic importance. Capital gains. Affect AGI. Affect capital gain bracket stacking. Affect NIIT. Affect credit phaseouts. Often tested heavily due to computational structure. 11 Labs Ready paragraph version. Capital gains and losses arise from the sale or exchange of a capital asset under Internal Revenue Code Section 1221, and gain is calculated under Section 10001 as the amount realized minus the adjusted basis. A capital asset generally includes investment property such as stocks, bonds, land, cryptocurrency, and personal use property, but excludes inventory, accounts receivable, and depreciable business property. Basis is typically the cost of the property adjusted for improvements, depreciation, or return of capital. The holding period determines tax treatment. Property held 1 year or less generates short-term gain, taxed at ordinary income rates, while property held more than 1 year generates long-term gain, taxed at preferential rates of 0%, 15%, or 20% depending on taxable income. Capital losses must first be netted against capital gains. And if losses exceed gains, individuals may deduct up to $3,000 per year against ordinary income, with excess losses carried forward indefinitely. Special provisions include the Section 121 exclusion, allowing up to $250,000 of gain for single taxpayers, or $500,000 for married filing jointly, on the sale of a principal residence if ownership and use tests are met. Wash sale rules disallow losses when substantially identical securities are repurchased within 30 days, and like-kind exchanges under Section 1031 allow deferral of gain on certain real property exchanges. Capital gains and losses directly impact adjusted gross income, net investment income tax exposure, and overall tax liability. Rental income. Core definition. Rental income is included in gross income under IRC Section 61A, 5. Rental income is payment received for the use or occupancy of property. Applies to residential property, commercial property, land, equipment. What counts as rental income? Included in gross income. Regular rent payments. Advance rent, taxed when received. Security deposits kept. Lease cancellation payments. Tenant-paid expenses on behalf of landlord. Property or services received in lieu of rent, FMV included. Advance rent is taxable when received, even if covering future periods. Security deposits. Refundable deposits are not income when received. If retained due to damage or lease breach, right arrow become income. Common exam trap. Rental expenses, IRC Section 212. Deductible expenses must be ordinary, necessary, directly related to rental activity. Common deductions. Mortgage interest. Property taxes. Insurance. Repairs and maintenance. Utilities, if landlord pays. Advertising. Property management fees. Depreciation. HOA fees. Repairs versus improvements. Repairs. Maintain property in ordinary condition. Fully deductible in year incurred. Improvements. Add value, prolong life or adapt property. Must be capitalized and depreciated. Highly testable distinction. Depreciation. Residential rental property. 27.5-year straight line MACRS. Commercial property. 39-year straight line MACRS. Land is not depreciable. Depreciation reduces basis and increases gain upon sale. Passive activity rules, IRC Section 469. Rental activities are generally passive. Losses may be limited. Special rule. Up to $25,000 rental loss may be deducted if taxpayer actively participates. AGI under 100,000. Phased out up to $150,000 AGI. Very heavily tested. Self-rental and real estate professional exception. Real estate professionals may avoid passive treatment if material participation tests are met. Rental versus personal use property. Vacation homes. Mixed-use property rules apply. Deduction limitations depend on personal use days. Personal residence rented fewer than 15 days. Rental income excluded. No rental deductions allowed. Extremely common EA exam question. At-risk rules, IRC Section 465. Losses limited to amount at risk. Applies before passive loss limitations. Reporting. Reported on Schedule E. Net rental income flows into Form 1040. Common EA exam traps. Taxing refundable deposits. Failing to include advance rent. Confusing repairs versus improvements. Forgetting depreciation requirement. Misapplying $25,000 passive loss allowance. Ignoring mixed-use property rules. Strategic importance. Rental income effects. AGI. NIIT, if passive. Passive loss carryforwards. Depreciation recapture on sale. Basis tracking. Often combined with passive loss and at-risk questions. 11 Labs Ready paragraph version. Rental income is included in gross income under Internal Revenue Code Section 61, subsection of 5, and represents payment received for the use or occupancy of property. Taxable rental income includes regular rent payments, advance rent, lease cancellation payments, security deposits that are retained, tenant-paid expenses on behalf of the landlord, and property or services received instead of cash rent at fair market value. Refundable security deposits are not income when received unless later kept. Deductible rental expenses under Section 212 must be ordinary and necessary and commonly include mortgage interest, property taxes, insurance, repairs, management fees, utilities, and depreciation. Repairs are currently deductible, while improvements that add value or extend useful life must be capitalized and depreciated. Residential rental property is depreciated over 27.5 years under straight-line MACRS, and land is not depreciable. Rental activities are generally treated as passive under Section 469, limiting loss deductions, although up to $25,000 of loss may be allowed for active participants with adjusted gross income under $100,000, subject to phase-out. Special rules apply to vacation homes and mixed-use property, and rental income and expenses are reported on Schedule E, flowing into adjusted gross income and impacting overall tax liability. Business income, Schedule C. Gambling income. Cancellation of debt income. Social Security benefits. Railroad retirement benefits. Alimony. Bartering income. Virtual currency. Hobby income. Kitty tax. ADGUSTMNTS, above the line. IRA contributions. HSA deduction. Self-employed health insurance. Student loan interest. Self-employment tax deduction. Alimony deduction, pre-2019 agreements. Deductions. Standard deduction. Itemized deductions. Medical expenses. State and local taxes, SALT. Mortgage interest. Charitable contributions. Casualty and theft losses. Gambling losses. Miscellaneous deductions, TCJA changes. Credits. Child tax credit. Additional child tax credit. Earned income tax credit. American Opportunity Credit. Lifetime Learning Credit. Child and Dependent Care Credit. Premium Tax Credit. Adoption Credit. Retirement Savings Contribution Credit. Taxes and Additional Taxes. Alternative Minimum Tax, AMT. Net Investment Income Tax, NIIT. Additional Medicare Tax. Self-employment tax. Early withdrawal penalties. Loss limitations. Passive activity loss rules. At-risk rules. Hobby loss rules. Capital loss limitations. Filing and dependency. Filing status. Dependency tests. Qualifying child. Qualifying relative. Support test. Tiebreaker rules. Tax-advantaged accounts. Health savings accounts, HSA. Section 529 plans. ABLE accounts. Small business basics. Sole proprietorship. Schedule C. Ordinary and necessary expenses. Home office deduction. Depreciation. Section 179. Gross income. Today we're diving into a fundamental aspect of taxation that every tax professional should have a firm grasp on: gross income as defined by Internal Revenue Code Section 61. So, what exactly is gross income? Well, think of it as the total amount of money, property, or services that you earn or receive before any deductions are taken out. It's essentially everything you've got coming in. Now, here's something to keep in mind. Gross income includes wages and salaries that you earn from your job. For instance, if you have a full-time job that pays you $50,000 a year, that entire amount counts as gross income. But it's not just about your paycheck. Let's say you also make an additional $5,000 from investments or that side gig you have going. Yep, that's part of it too. But the fun doesn't stop there. Gross income also involves other elements like rental income from properties you own, business profits if you're self-employed, and even capital gains if you sell an asset for more than you bought it. So remember, it all adds up. Now, here's the important part. While understanding gross income, it's crucial to be aware of the current thresholds and limits that apply. For the year 2024, for instance, the standard deduction for individual filers is $27,000. What this means is, if your gross income exceeds this threshold, you will have to pay taxes on the income above that amount. So, if you earned $50,000, after taking away that standard deduction, you would be taxed on $23,000. However, there are some common pitfalls that many overlook. Sometimes people forget to include all their income sources, like side jobs or freelance work, and if you misclassify your income, that could spell trouble. Also, keep an eye out for exclusions. Some income types, like certain gifts received, may not require reporting. As an enrolled agent, you need to be adept at identifying all the various income sources and staying updated on what's currently applicable. Make sure you understand how these exclusions can benefit your clients. Avoid common mistakes and ensure all income is reported correctly to minimize audit risk. In summary, grasping the concept of gross income, as laid out in the Internal Revenue Code Section 61, is essential in navigating the world of taxation. It's your foundation for understanding tax liabilities and advising clients effectively. So take this knowledge with you, and you'll be well on your way to mastering the intricacies of individual taxation. Wages, salaries, and tips. Hello there. Today we're diving into a fundamental topic for the enrolled agent exam: wages, salaries, and tips. These components represent the core of many people's incomes, and understanding them is essential for reporting taxes accurately. Let's unpack these terms clearly. First, let's talk about wages. When we say wages, we're generally referring to the money that employees receive based on the hours they've worked. Think of it like this. If someone earns $20 an hour and works 35 hours in a week, they'll take home $700 before taxes. It's straightforward, but here, where it gets a bit more complex. Salaries, on the other hand, are paid as a set amount over a year, which we often hear as an annual figure. For example, if a teacher's contract states they earn $50,000 a year, they will receive a regular paycheck amount, whether they work fewer or more hours each pay period. Good to know, right? And now let's think about tips. Tips can be tricky. If you work in the service industry, tips represent that extra income you get from customers, which is typically separate from your hourly wages. If a server receives $15 in tips during one shift, even though that might seem small, it actually needs to be reported as income, especially if it goes over $20 in a month. Let's pause for a moment. Remember, every bit counts in the eyes of the IRS. Now, what are the current rules regarding reporting these incomes? For tax year 2024, the IRS has set the standard deduction for married couples at $35,000. That means if a couple earns less than this amount, they may not owe any federal income tax. Pretty handy to know, right? Be mindful of some common mistakes as well. It's all too easy for individuals to overlook reporting all their tips or to miscalculate their total taxable income. For instance, they might forget that any amount received over $20 in tips must be included. This oversight can lead to audits or penalties, which no one wants. Lastly, as an enrolled agent, it's essential to guide your clients accurately and ensure they're on track with their withholdings. Accurately reporting taxes can save money in the long run. So remember these essential tips when preparing for the exam: wages, salaries, tips, accurate reporting, and understanding the deductions. And that's a wrap on our important overview. Thanks for tuning in and happy studying. Interest and dividend income. Hello, students. Today, we're diving into the world of interest and dividend income, an essential topic for anyone preparing for the enrolled agent exam. A core principle to remember is that both interest and dividends are taxable income according to the Internal Revenue Code. Now, let's break that down a bit. Interest income is really the money you earn from lending your assets. Think about it like this. When you place money into a bank, what do you expect in return? Exactly, some interest on your balance. If you have $1,000 sitting in a savings account and you earn $100 in interest over the year, guess what? That $100 is considered taxable income. You'll get a Form 1099 from the bank confirming that, and you'll need to report it on your tax return. Now, let's move on to dividends. Dividends are those sweet payments you get from owning stock in a corporation. Imagine you have shares in a big company. If they decide to distribute profits back to their shareholders, you might receive a dividend check. Say you received $500 in dividends this year. That's also taxable. It's essential to note that dividends can be either cash or stock, but both must be reported. Now, here's the important part. As of 2024, there's no minimum amount that you can ignore. Everything counts. Even if you think it's a small amount, you need to report it. Tax laws can be tricky. Dividends are classified as either qualified or ordinary, which determines how much you'll pay in taxes. Qualified dividends are taxed at lower rates, while ordinary dividends are taxed at your regular rate. Keeping track of these different types is vital. One common mistake I see often with clients is forgetting to report all that interest income, especially if it's from multiple accounts. It's like leaving money on the table. You have to report it all, no matter how small. Also, misclassifying the types of dividends can lead to higher taxes, and that's not what you want, right? Remember, the distinction matters. Remind your clients about receiving Form 1099 because it can catch this income that they shouldn't overlook. As an enrolled agent, here's what you need to hold on to. Always guide your clients to understand the significance of accurate reporting on their tax returns. Staying updated on changes to tax brackets is key too because those affect how dividends will be taxed year to year. Think of it like a race. If you don't know the course, you might not finish at your best. In conclusion, whether it's interest from a savings account or dividends from stocks, getting your tax reporting right is essential. As you prepare for your exam, keep these concepts and details at the forefront of your study. Good luck. Capital gains and losses. Today, let's dive into the world of capital gains and losses. It sounds complicated, but once you get the hang of it, it's quite manageable. Now, capital gains happen when you sell an asset for more money than you paid for it. Imagine you bought a stock for $10,000 and later sold it for $15,000. That's a $5,000 capital gain. Simple enough, right? On the other hand, a capital loss occurs when you sell an asset for less than what you paid. So if you bought a piece of property for $100,000 and sold it for $80,000, that's a $20,000 capital loss. Now, let's break these down a little further. There are two types of capital gains, short-term and long-term. Short-term capital gains apply to assets held for 1 year or less. They're taxed as ordinary income, which means they can hit you with rates as high as 37%. But wait, here, the kicker. If you hold that same asset for more than 1 year, you qualify for long-term capital gains, which usually come with much lower tax rates of 0, 15, or 20% depending on how much you make in a year. For 2024, if you're single and your total income is up to $40,000, you'll pay a 0% tax on long-term capital gains. If your income is between $41,400 and $81,400, expect to pay a 15% rate. Now, if you're married filing jointly, those numbers shift slightly, doubling some of those thresholds. So, if you're savvy enough to hold an investment for a year or longer, you could save a lot on your taxes. Now, it's crucial to know these figures as they stem from the Internal Revenue Code. Specifically, Internal Revenue Code Section 1H outlines how these capital gains are taxed. And Internal Revenue Code Sections 1211 and 1212 talk about how you can offset those capital gains with losses, which is really, really important. It's like a tax shield. If you make $50,000 from selling stocks this year, but lost $20,000 from another investment, you're only taxed on the $30,000 of net gain. But be careful. One common mistake people make is not keeping track of whether their gains are short-term or long-term. This can lead to paying higher taxes than necessary. Plus, if your capital losses exceed your gains, you can often only deduct up to $3,000 against your income per year, rolling any extra losses over to future years. So, remember the basics. Capital gains and losses impact your taxes significantly, and understanding the rules means you can better plan for them. Whether you're preparing for your taxes or helping clients with theirs, knowing the ins and outs of capital gains will serve you well. Keep these points in mind, and you're one step closer to mastering capital gains and losses. Rental income and expenses. Let's talk about rental income and expenses, a fundamental topic for anyone involved in individual taxation. Now, when we mention rental income, we're referring to the money you receive from renting out property. According to the Internal Revenue Code Section 212, this income must be reported on your tax return. So, whether you're getting steady monthly rent from a tenant or you've received advance rent, like a lump sum before the rental period begins, everything counts as income. For example, imagine a guy named John. He rents out his apartment for $1,000 a month. Over the course of the year, John collects $12,000 from his tenant. But let's say he also gets a bit ahead and receives an additional $2,000 in advance rent one December. Now, here's the important part. John needs to report that $14,000 as his rental income for that year. Now, rental expenses. That's where things can get interesting. These are the costs you incur to keep your property functional and in good condition. The Internal Revenue Code Section 280A lays out that these expenses must be both ordinary and necessary. Think about things like repairs, advertising the property, and even hiring a property management service. For example, if John spends $3,000 on repairs that keep his apartment in good shape, $250 to advertise it online, and $1,000 for a management team to handle tenant issues, he can deduct those from his income. So, if we add up his expenses, $3,000 plus $250 plus $1,000, he's looking at a total expense for that year. That's the number he'll subtract from his total rental income to figure out his net income. Now, let's pause for a second and think about common mistakes. One big pitfall is failing to keep accurate records. If John mixes his rental and personal expenses, it can lead to errors on his tax return, and nobody wants that. Additionally, every penny of rental income, no matter how small, must be reported to the IRS. Failing to do so could land you in hot water. As an enrolled agent, what do you need to keep in mind here? First off, know the codes inside and out. That's crucial for interpreting rental income and expense regulations. Also, you want to guide clients toward maintaining accurate records of their transactions. A good record-keeping system can save a lot of headaches come tax season. Before we wrap up, let's recap some key points. Remember, all rental income needs to be reported, and only expenses that are ordinary and necessary can be deducted. Keep separate accounts for personal and rental transactions. That's a must. And here's a tip for your exam. Focus on understanding the difference between deductible and non-deductible expenses. Getting those distinctions right will help you shine on test day. So, dive into these concepts, practice with real-world examples, and you'll be well on your way to mastering rental income and expenses. Social Security and railroad retirement. Hello there. Let's take a moment to break down an important topic in tax preparation that many individuals face. which is Social Security and railroad retirement benefits. Understanding how these benefits are taxed is crucial, particularly for tax professionals like enrolled agents. We will drill down into the taxation of these benefits based on the guidelines set by the Internal Revenue Code, specifically Section 86. Now, Social Security benefits are provided to retired, disabled, or deceased workers. The amount you receive can vary widely, depending on your work history and when you choose to start receiving benefits. For instance, in the year 2024, if you're a single filer, you can earn up to $25,000 without your Social Security benefits being taxed. But if your income goes over that amount, you might have to pay taxes on a portion of your benefits. Let's think about that for a second. When we talk about taxes, what we really mean is your combined income. This is calculated by taking your adjusted gross income, adding any non-taxable interest you might have, and then adding half of your Social Security benefits. If you find that your combined income exceeds $25,000, then you could be taxed on up to 50% of your benefits. If it exceeds $34,000, that number jumps to 85%. For example, picture a taxpayer who collects $15,000 in Social Security and has an adjusted gross income of $10,000. Their combined income, which totals $22,000, is below the $25,000 threshold. In this scenario, none of their Social Security benefits would be taxable. Now, let's switch gears for a moment and talk about railroad retirement benefits. These benefits are slightly different. Tier 1 benefits operate just like Social Security regarding taxation. However, Tier 2 benefits are treated differently. They are fully taxable as income. So, if you're advising a client who is retired from working with railroads, it's essential to distinguish between Tier 1 and Tier 2 benefits. Many may not realize these differences and could end up filing incorrectly, particularly if they think Tier 2 benefits are exempt from taxes. Now, I want you to be aware of some common pitfalls. One mistake I often see is taxpayers ignoring their combined income when calculating taxes owed. This oversight can lead to underreporting and ultimately a tax bill that could surprise them. Another issue is the misclassification of benefits. Failing to recognize which type of railroad retirement benefit they are dealing with could lead to incorrect filings and significant tax confusion. For enrolled agents, being in the know about these specifics is vital. You must ensure your clients understand how to calculate their taxable portion of both Social Security and railroad retirement benefits. Keep up to date on the thresholds and regulations, as these can change. This is key for effective tax planning and for helping clients maximize their benefits while accurately reporting their taxes. Before we wrap up, let's recap some key points. Remember, Social Security benefits are partially taxable based on income thresholds. Your combined income includes various parts: your adjusted gross income, plus any non-taxable interest, plus half of your Social Security benefits. When it comes to railroad retirement, Tier 1 benefits are taxed like Social Security, but Tier 2 benefits are fully taxable. And here's a quick tip for your exam preparation. Don't forget to refer to Internal Revenue Code Section 86, along with checking the latest IRS publications for current thresholds and tax guidance concerning these retirement benefits. Staying informed is your best strategy. Alimony and separate maintenance. Today, we're diving into a topic that's vital for any tax professional: alimony and separate maintenance. Let's start with the basics. Alimony is a court-ordered payment from one spouse to another after a separation or divorce. Now, here's the important part. There are specific guidelines that must be met for these payments to be considered deductible for the payer and taxable for the recipient. Just imagine a couple, John and Sarah. After they divorce, John is required to pay Sarah $2,000 each month. Because this is a court-ordered payment, John can deduct that amount when he files his taxes, and Sarah must report it as income. It's quite straightforward when you think about it in these terms. Next, let's talk about separate maintenance. This is a bit different because it often occurs when the couple is still legally married but living apart. For example, let's imagine Alice and Bob. Though they haven't divorced, Bob might provide Alice with financial support. Just like with alimony, these separate maintenance payments can also be deductible for Bob and taxable for Alice. However, It's key that they adhere to the same guidelines as alimony. Otherwise, they might run into trouble come tax season. So, as we look at the current numbers, there aren't specific dollar limits for alimony. That means that as long as the payments fit the criteria, like being made in cash and under a divorce decree, the amounts can vary widely. But remember, child support is a different ball game. It's neither deductible for the payer nor taxable for the recipient. This is a common misunderstanding and one that can lead to mistakes. Now, let's pause for a moment. I want to stress the importance of keeping proper documentation. Both parties need to maintain records to validate claims during tax filing. For instance, if John and Sarah ever decide to change the arrangement due to a new job or lifestyle change, those updates need to be documented immediately. In practice, it's your job as tax professionals to clarify these issues for your clients. You need to educate them about the requirements and ensure they understand the tax implications of any changes in their situation. Also, staying informed about any state-level laws affecting marital support can really set you apart. Remember, proper guidance can save clients from potential tax pitfalls. Before we wrap this up, let's recap what we've learned. Alimony payments have specific tax consequences, separate maintenance follows similar rules, and child support, well, that's a completely separate issue altogether. Keep this in mind as you prepare for the EA exam. Knowing the differences and tax treatments can make all the difference, not just for your test, but also in your career. Good luck. Gambling income and losses. Gambling can be a fun pastime for many, but when it comes to taxes, it gets a little tricky. So let's dive into gambling income and losses and how they affect your tax situation. First things first, it's important to know that all gambling winnings are taxable. That's right, whether you hit the jackpot at a casino or win a large sum from a lottery ticket, that money has to be reported on your federal income tax return. This is covered under Internal Revenue Code Section 1121. Now, imagine you go to a casino and win $50,000. That's a big win. You celebrate, but remember, Uncle Sam wants a piece of that too. You might not receive a tax form for every single winnings, but your responsibility remains the same. You have to report that entire $50,000 as income. If you're thinking, oh, they never reported it to me, so I don't have to pay taxes on it. Hold on right there. All gambling income is taxable, and not reporting it can lead to some serious issues down the line. So what about gambling losses? This is where things can get a little confusing, because while losses are potentially deductible, they come with a catch. According to Internal Revenue Code Section 165, specifically subsection D, you can only deduct your losses up to the amount you've won. Let's take an example to help clarify this. Let's say you managed to win $50,000, but during your gambling adventures, you lost $20,000. Good news. You can deduct that $20,000, but here's the key. You can't claim any more than what you won. So even with that $20,000 loss, your net taxable gambling income sits at $30,000. This means you'll report $30,000 on your tax return. Now, keep in mind that, for tax year 2024, there are certain thresholds for when you must report your winnings. If you win $300 or more from games like bingo or slot machines, or $500 from poker tournaments, those amounts absolutely must be reported. Here come the usual mistakes that tend to trip people up. One common error is not reporting all their winnings. Gamblers might forget smaller wins, thinking they've escaped notice, but guess what? Everything is taxable. Another trap is thinking they can deduct losses that exceed their winnings. Remember, losses are only deductible up to the income reported from gambling. And let's not forget documentation. Without it, you might as well be tossing away your chance to deduct those losses. In practice, as an enrolled agent, you need to guide your clients on these points. Make sure they know to report all winnings, understand the limitations on deductions, and keep accurate records of their gambling activities. If your client walks away from a night at the casino with nothing but bad luck, they simply can't deduct their losses. So in summary, gambling income is taxable, losses can be deducted, but only to the extent of winnings. Stay on top of those record-keeping practices and educate your clients. This is the way to go. Remember, Clear documentation is key to a successful tax year when it comes to gambling. Cancellation of debt income. Hello, everyone. Today we're venturing into a topic that can really impact a lot of taxpayers: cancellation of debt income. You might often hear it referred to as COD income. Now, what does this mean? Well, it comes into play when a lender decides to forgive or cancel a borrower's obligation to pay back their debt. And you guessed it, typically this form of income is taxed by our friends at the IRS. But hang on, there are exceptions to this, and we'll dive into those shortly. Let's start with some everyday examples. Imagine Sarah. She has a student loan of $15,000, right? Now, due to a tough financial situation, her lender decides to forgive $10,000 of her debt. Whoa, that sounds great, but here's the important part. Sarah will likely need to report that $10,000 as income on her tax return. So suddenly, her financial break isn't entirely free. Now, think about John, who has a mortgage of $250,000. After losing his job, he negotiates with the bank, and guess what? They forgive $50,000. Again, important to remember. John also has to report that $50,000 as cancellation of debt income unless there are specific exceptions that apply. This brings us to the Internal Revenue Code Section 108, or IRC Section 108 for short. This section explains when cancellation of debt income is considered taxable and outlines the exceptions. For example, if a debt is discharged in bankruptcy, or if someone is considered insolvent, that means their liabilities exceed their total assets. They might not need to report this income. So, if John was actually insolvent at the time of that $50,000 cancellation, he may not have to report it. That's huge. Now, let's talk about common pitfalls, places where taxpayers trip up. One big mistake is thinking all cancellation of debt is automatically exempt from taxes. It's critical for clients to understand those specific exceptions. Another common blunder is failing to report COD income at all. This can lead to nasty surprises come tax time. And don't forget, if someone miscalculates their assets and liabilities, they could wrongly assume they qualify for that insolvency exclusion. As an enrolled agent, you need to be on top of these essentials. It means knowing how to document these cancellations properly and advising clients about their tax liability. Keeping meticulous records of any debt cancellation is critical. And during tax season, you'll need to make sure they correctly report this on the necessary forms, such as Form 982. So remember our takeaways. Cancellation of debt income is usually taxable unless specific exceptions apply, like bankruptcy or insolvency. Always be clear and precise with clients about what needs to be reported come tax time. As you prepare for your exam, focus on understanding IRC Section 108 and its exceptions. That's going to serve you well. All right, that wraps up our overview on cancellation of debt income. Keep these points in mind, and you'll be well prepared for both your exam and helping clients navigate tax season. Bartering and virtual currency. Welcome to today's lesson on bartering and virtual currency. Now, you might be wondering, what exactly is bartering? Let's think about it for a second. Bartering is when you exchange goods or services directly for other goods or services. It's like trading your services as a graphic designer for a nice meal at a local restaurant. So, if you do a redesign of their menu and they serve you gourmet dinner worth $400, you need to report that $400 as income. You didn't receive cash, but you did receive value. Now, here's the important part. According to Internal Revenue Code Section 61, all income, whether cash or non-cash, must be reported. Imagine your friend makes beautiful handmade jewelry and she trades some pieces for music lessons with you. That jewelry has value too, right? So, while it may seem like a simple trade, it's still taxable. Now, let's shift gears a bit and talk about virtual currency. This is a hot topic right now. Virtual currencies, like Bitcoin or Ethereum, are online currencies that function just like regular money but are entirely digital. Isn't that fascinating? The interesting part here is that the IRS treats virtual currency as property. That means if you barter or sell virtual currency, any gains you make are considered taxable income. For instance, if you bought a Bitcoin for $10,000 and later exchanged it for $2,000 worth of goods, you need to report that gain. As of 2024, if you engage in a virtual currency transaction worth more than $600, you have to report it. This sum is similar to the reporting threshold that applies to cash transactions. It's key to keep track of these transactions. Always record the date, the amount of virtual currency used, and its fair market value at the time of the transaction. Common mistakes often happen here. Some people forget they have to report income from bartering or don't assess the fair market value correctly. It's so easy to underestimate value when you find yourself in a trade. But remember, the IRS expects you to document and report that, just as you would with cash. So, what should an enrolled agent keep in mind about this subject? Firstly, make sure your clients understand that receiving value through barter means they have a tax obligation. Secondly, encourage them to maintain accurate records, as this can help avoid trouble with the IRS down the line. In conclusion, whether through bartering or via virtual currency transactions, income is income. Awareness, accurate documentation, and understanding value are your best tools here. Thank you for listening and happy studying. Standard deduction versus itemized deduction. Hey there! Today, we're going to talk about something every taxpayer and enrolled agent must know: the difference between the standard deduction and itemized deductions. It may sound a bit complex, but don't worry. I'm here to break it down for you in an easy-to-understand way. First, let's start with the standard deduction. It's essentially a flat amount you can subtract from your income to reduce how much tax you owe. For the tax year 2024, if you're married and filing jointly, that amount is $27,000. If you're single or married but filing separately, it's $13,500. And if you're the head of household, it's $20,000. So that's the basic idea, a nice, straightforward deduction that most taxpayers can take without much hassle. Now, on to itemized deductions. These are a bit different. Instead of a flat amount, you get to deduct specific expenses. For example, you can deduct things like medical expenses if they exceed 7.5% of your adjusted gross income. You can also include state and local taxes, mortgage interest, and charitable contributions. Sounds good, right? Well, here's the catch. You need to keep detailed records of those expenses. Picture this. Let's say we have a couple, John and Mary. They file jointly and earn $100,000. They've paid $10,000 in mortgage interest, $2,000 in state taxes, and $500 in medical bills. When they add all that up, their itemized deductions come to $12,500. But here's the kicker. If they just take the standard deduction, they would get $27,000. Quite a difference, isn't it? Let's think about that for a second. Choosing between the two can significantly impact how much tax you owe. So, if their total itemized deductions don't surpass the standard deduction, it's a no-brainer. Go with the standard deduction. But there's more to know. Itemized deductions have limitations too, especially for those with higher incomes. The limits begin to phase out when a married couple's income exceeds $400,000. That means the more money you make, the less you can deduct. It's a bit ironic, right? So you certainly want to advise your clients carefully about what deductions they're eligible for. Now, a quick tip to avoid pitfalls. A frequent mistake is assuming that itemizing is always better. Some people forget to keep detailed records, and that can lead to a big headache if they get questioned about their deductions. Remind your clients about the importance of documentation, especially if they opt for itemizing. To summarize, remember this. The standard deduction is simple and a fixed amount, while itemized deductions require you to list out expenses and keep good records. Choose wisely based on what benefits you or your clients the most. So, when you're studying for your EA exam, always remember to analyze scenarios that present both options. Understanding the nuances of these deductions is key to serving your clients effectively. That's all for today. Happy studying. Medical and dental expenses. Today, we're going to dive into a very important topic for tax preparation, particularly for those studying to become enrolled agents. We'll focus on medical and dental expenses and how they can impact a taxpayer's return. So, let's get started. When we talk about medical and dental expenses, we're referring to costs incurred by taxpayers that can potentially be deducted from their taxable income. According to what's outlined in Internal Revenue Code Section 213, there are certain medical expenses that you can consider for your deductions. This means that if taxpayers have spent a significant amount on medical or dental costs over the year, that money could come back to them in the form of a tax deduction. Now, let's clarify what qualifies as deductible medical expenses. Health insurance premiums that individuals pay out of pocket, prescription medications, and even dental expenses like cleanings and fillings can be deducted. Think about it this way. If someone pays $25 for a prescription that's necessary for their health condition, that cost can typically be deducted from their taxable income. Additionally, services related to long-term care can also qualify for deductions under this code. But here's where it gets a bit complex. To actually benefit from deducting these expenses, taxpayers must have total eligible medical expenses that exceed a certain threshold, which is currently 7.5% of their adjusted gross income. Let's take a practical example here. If someone's adjusted gross income is $50,000, they would only be able to deduct medical expenses that surpass $3,750. So any medical expenses greater than that amount can be a credit on their tax return. Another critical point to remember is to keep meticulous records. Many taxpayers either lose receipts or don't document their expenses correctly, leading them to miss out on deductions they rightfully deserve. It's also important to note that if the taxpayer is reimbursed for their expenses, they cannot claim what they've already been compensated for. So if a doctor visit cost $100, but the insurance reimbursed them $75, only the remaining $25 is eligible for deduction. Enrolled agents should be well-equipped not only to help clients navigate these deductions, but also to advise them on potential pitfalls. It's vital for them to educate taxpayers on keeping records of expenses, knowing what qualifies for deductions, and the significance of understanding the legal limits surrounding health savings accounts, which have their own contribution caps that can affect how much can be deducted. In summary, understanding medical and dental expenses isn't just about knowing what you can deduct, but about being organized and informed. A good grasp on this aspect can really make a difference in your client's tax outcomes. So that's a wrap on our discussion about medical and dental expenses related to tax preparation. Remember, always check for current thresholds and rules, and happy studying. State and local taxes, SALT. Hello and welcome to our discussion about state and local taxes, often just called SALT. Let's break it down into something manageable. So first off, what exactly is SALT? Essentially, these are the taxes imposed by state and local governments. They can be on a variety of things: your income, your property, or even certain transactions. Understanding how these taxes work is crucial because they can really affect your overall tax burden and financial well-being. Now, let's think about state income taxes. Most states have some form of an income tax. For example, if you're living in California and you earn $75,000 in a year, you can expect to pay a state income tax. Let's say you paid about $5,000 in state taxes that year. That's something you might be able to deduct when you're filing your federal tax return. That's how it can work for you. We also have local taxes. These are taxes that might be imposed by your city or county. Think of a resident living in Philadelphia. Alongside their state income tax, there could be additional local taxes that they're paying as well. You can see how these local taxes can add up. And let's not forget about property taxes. If you own real estate, you're likely paying property taxes based on the value of that property. Just imagine someone who owns a house worth $300,000. And they might be paying around $4,000 annually in property taxes. There's another deduction you could potentially claim. Now here's the important part. Thanks to the Tax Cuts and Jobs Act, there is a limit to how much of these taxes you can deduct. Currently, for individual filers and married couples who are filing jointly, the maximum deduction is capped at $10,000. For those of you filing separately, that limit drops to $5,000. This cap can pose real challenges, especially for those living in states with higher taxes. Let's pause for a moment and talk about common pitfalls. Sometimes people think they can deduct both state and sales taxes, but that's not allowed. Remember, you can only choose one deduction. Additionally, don't overlook the local taxes that might apply. They can really sneak up on you. Keeping good records of what you're paying is critical too. Not having proper documentation could lead to missed opportunities for deductions. As an enrolled agent, it's essential to really understand these various taxes and to keep up to date with changes. Tax laws can shift, and it's your job to help your clients navigate these waters effectively. You want to make sure you know the ins and outs of state and local taxes. This means knowing the current rates and how those can interact with federal taxes. Before we wrap up, let's highlight some key points. First, SALT includes state income, local taxes, and property taxes, all of which are connected to Internal Revenue Code Section 164. Second, remember that $10,000 cap on deductions. Third, be mindful of those common mistakes. And lastly, staying updated on state tax regulations is key. I hope this overview helps you feel more confident about state and local taxes. They're not just numbers, they have real implications in the lives of taxpayers. Mortgage interest deduction. Welcome back to our discussion on tax deductions, where today we're diving into the incredibly important topic of the mortgage interest deduction. Now, you might be wondering, what exactly is the mortgage interest deduction? Essentially, it's a tax benefit that allows homeowners to deduct the interest they pay on their mortgage from their taxable income. It's like getting rewarded for investing in your home. This benefit can significantly reduce your tax burden, especially in those early years when most of your mortgage payments go toward interest. So let's break it down a bit further. According to the Internal Revenue Code Section 163H, homeowners can deduct interest on mortgages secured by their primary residence or, in some cases, a second home. This is important because it means as long as the loan is tied to either a primary or second residence, the interest on the mortgage may be deductible. Now, here, where it gets specifically interesting, there are limitations in place. For tax years 2024 and 2025, if you're filing jointly as a married couple, you can deduct interest on the first $750,000 of your mortgage balance. If you're filing as a single individual, that limit goes down to $375,000. So, if you have a mortgage that's higher than those amounts, only the interest on that qualifying portion is deductible. Let's think about a practical example. Suppose you purchased a home for $400,000 and took out a mortgage for $350,000. If your interest payments for the year amount to $30,000, congratulations, you can deduct that entire amount. However, if your mortgage was actually $1 million, you need to realize only the interest on the portion up to $750,000 would be deductible. The rest, well, that's not going to help you come tax time. Now, as an enrolled agent, you need to be aware of some common pitfalls people fall into. One prevalent mistake is not itemizing deductions at all, often because individuals assume the standard deduction will always be better for them. For instance, in 2024, the standard deduction for married couples is $27,700, and for single filers, it's $13,700. Always do the math to see what works best. Another mistake involves the refinancing confusion. When homeowners refinance, they think all the interest can still be fully deducted, but that's not quite right. You must only consider the interest on the new loan's qualifying amount, which can lead to surprises if not accounted for correctly. As we wrap up, here's a key point to remember. Make sure you understand both sides of the coin, the limits and eligibility criteria, while also keeping yourself updated on any changes to tax laws that could impact your clients. So, as you prepare for the enrolled agent exam, focus on the nuances of the mortgage interest deduction. Understanding both the calculations and real-world scenarios will not only serve you well on the exam, but in practice, too. Charitable contributions. Hello, future enrolled agent. Today we're diving into the topic of charitable contributions, a subject that's not only important for tax purposes, but also allows taxpayers to support the causes they care about. Now, when we talk about charitable contributions, we often refer to Internal Revenue Code Section 170, which lays out the guidelines for deducting these contributions. Let's start with the basics. To qualify for a deduction, a contribution must be made to a recognized charitable organization. This typically includes organizations that are classified as 501(c)(3) nonprofits. These are charities organized for charitable, religious, educational, or scientific purposes. Imagine you're supporting a local food bank or funding scholarships at a school. Those donations typically fall under this category. Now, here's the important part. When it comes to deducting these contributions, there are limits to how much taxpayers can deduct based on their adjusted gross income, or AGI. For the years 2024 and 2025, if a taxpayer donates cash, they can deduct that cash up to 60% of their AGI. That's a pretty generous limit. But let's say instead of cash, the taxpayer decides to donate an old vehicle or some personal property. In that case, they generally can only deduct up to 30% of their AGI. The key here is they need to know which type of property they're donating because it significantly affects their deduction. Furthermore, documentation is essential. For cash contributions, it's wise for individuals to keep their bank statements, canceled checks, or receipts. If the donation exceeds $250, they need to secure a written acknowledgement from the charity. This should include details like the charity's name, the date of the contribution, and the amount given. Now, let's think about that for a second. What happens if someone fails to secure proper documentation? Well, without it, the taxpayer risks having their deduction disallowed during an audit, which can lead to some undesirable consequences at tax time. As an aspiring enrolled agent, you'll need to help your clients navigate these rules carefully. Make sure they know how to choose a qualified charity and stress the importance of keeping detailed records. It's also helpful to keep your clients informed about changes to the tax law that might affect their charitable giving. In summary, understanding the ins and outs of charitable contributions will not only help your clients maximize their deductions, but will also ensure they remain compliant with current tax laws. Remember the distinctions between cash and property contributions, their limits, and the need for thorough documentation. All of these points could very well come up in your exam, so keep them fresh in your mind as you prepare. Good luck on your journey to becoming an enrolled agent. Casualty and theft losses. Hello there. Today we're diving into the topic of casualty and theft losses. Now, this may sound a bit technical, but stick with me. It's more straightforward than it seems. So, let's think about what a casualty loss really is. Imagine you're living in an area prone to hurricanes, for example, Florida. If a hurricane damages your home, you have what we call a casualty loss. This is important because it could affect how much tax you owe come filing season. According to Internal Revenue Code Section 165, you can deduct these losses if they meet certain conditions. First, you need to identify what caused your loss, whether it's a natural disaster like a hurricane, a car accident, or even theft. Then, you will have to determine how much your property was worth before the event happened and how much it's worth afterward. So, if your home was worth $250,000 before the hurricane and it drops to $200,000 after, you'd have a loss of $50,000, right? But here, where things get interesting. If you received an insurance payment of $20,000 for your damages, that means your deductible loss now reduces to $30,000. It's crucial to keep track of these figures. Every dollar counts. Now, let's talk about the thresholds for deductions. In 2024, things get a bit clearer. For example, if you structure your claims based on personal property losses, the calculations will vary. Always remember, there's this $200 limit for losses, and then a crucial 10% rule based on your adjusted gross income. For example, if your income is $50,000, you'd only get to deduct losses exceeding $5,000 after accounting for that $200 limit. It's like a gatekeeper to your deductions, ensuring only significant losses come through. But beware, there are common mistakes people make when it comes to these claims. Some may overestimate their losses. Instead of guessing, it's best to document everything meticulously, photos, repair bills, you name it. And remember, if you've got insurance, any reimbursement you receive needs to be reported as it reduces your loss amount. So as an enrolled agent, you have a critical role in helping your clients navigate these waters. You want to ensure they understand what qualifies as a casualty loss, educate them on necessary documentation, and verify that they understand how insurance payouts will influence their claims. All right, here's a key takeaway. If ever you are assessing a loss, always remember to check your client's losses against the IRC guidelines. especially that $200 floor and the 10% adjusted gross income limit. This will make a big difference in how much they can deduct. So when the exam day comes, be sure to really understand these concepts and be ready to apply them. You'll want to make sure your answers reflect an understanding of the nuances in casualty losses versus theft losses, and trust me, that could make all the difference. Good luck. Miscellaneous deductions, post-TCJA. Hello everyone. Today we're going to talk about a very important topic regarding miscellaneous deductions, especially in the wake of the Tax Cuts and Jobs Act. Now, let's think about that for a second. Before the Tax Cuts and Jobs Act, taxpayers had the ability to claim various miscellaneous itemized deductions once those deductions exceeded 2% of their adjusted gross income. However, this all changed with the enactment of the Tax Cuts and Jobs Act, which suspended these deductions starting with tax year 2018. So, what's the implication for taxpayers? Essentially, if you had expenses like unreimbursed employee expenses, tax preparation fees, or any investment-related expenses, you could have previously deducted the amount that exceeded the 2% threshold. For example, say your adjusted gross income was $50,000 and you had $4,000 in unreimbursed expenses. You would only bring into account the amount exceeding $1,000. But now, due to the changes brought about by the Tax Cuts and Jobs Act, those deductions have been suspended entirely. So, rather than claiming a $400 deduction on your taxes, you would now find that you can't deduct anything at all. This can be a shock to many taxpayers, especially those who are used to itemizing their deductions. It's also vital for tax professionals, particularly enrolled agents, to understand Sections 67 and 212 of the Internal Revenue Code. These sections detail what miscellaneous deductions are and explain the changes wrought by the law. Now, let's differentiate between the options available before and after the TCJA. Before the changes, miscellaneous deductions provided a way for taxpayers to potentially lower their tax burden significantly. Now, with deductions suspended, it's crucial for enrolled agents to explore alternative tax strategies that might help their clients. Common mistakes that we see include taxpayers assuming these deductions still exist, or even relying on outdated advice from tax preparation services that haven't kept up with the changing laws. As an enrolled agent, your role involves staying updated on such changes and clearly communicating them to your clients. Helping them understand that they will not be able to claim these deductions can help mitigate confusion and disappointment come tax time. In essence, your primary objective should be to educate your clients and to explore other areas where they may save on taxes, such as utilizing increased standard deductions or seeking out eligible tax credits. Always remember, while many deductions may no longer apply, there will still be tax strategies that can work in your client's favor. So keep this information close at hand as you prepare for your enrolled agent examination. Understanding the evolution of deductions under the Tax Cuts and Jobs Act is essential for effective tax planning and represents quality service to your clients. That's all for now, and remember, tax laws evolve, so stay informed. Filing status and requirements. Hello students, today we're diving into a fundamental topic in tax preparation: filing status and requirements. Now, you might be wondering, why is filing status so critical? Well, let's think about that for a second. Your filing status affects your tax rates and how much tax you ultimately owe, not to mention the eligibility for various deductions and credits. There are 5 main types of filing statuses: single, married filing jointly, married filing separately, head of household, and qualifying widow or widower. Each of these comes with its own rules and tax implications. First, the single *** status applies to anyone who is unmarried or legally separated at the end of the year. For 2024, if you're filing as single, your standard deduction is $38,000. Make sure to remember this, as it can significantly reduce your taxable income. Moving on to * married filing jointly ***. If you're married, most couples find this is the most beneficial way to file. You combine both incomes, which for 2024 allows you a standard deduction of $76,000. Couples should look into this option, as it generally leads to a lower tax bill compared to filing separately. Now, that leads us to married filing separately ***. Some couples choose this route for various reasons, but beware. When you file separately, you're giving up certain tax credits and may end up paying more in taxes. Each spouse claims their own standard deduction, which is again $38,000 for 2024. It's all about weighing your options carefully. Then there's the asterisk head of household *** status. This is quite valuable. You can claim it if you're unmarried and have a qualifying dependent. The standard deduction here is $57,000 in 2024. If you qualify, it's worth it to use this status since it gives you a larger deduction than filing single. Lastly, we have the qualifying widow or widower ** status, which is available for 2 years after a spouse's death. If you have a dependent child, you can take advantage of the same standard deduction as married couples filing jointly. Now, here's the important part. Understanding the requirements for each of these statuses is crucial. Misclassifying your status can lead to costly tax mistakes. For example, if you mistakenly file as single when you qualify for head of household, you're likely paying more tax than you need to. As enrolled agents, our job is to accurately assess each client's circumstances and help them find the filing status that offers the best financial advantage. Remember to always reference the Internal Revenue Code sections. We often look to Section 1 for tax rates and Section 2 for standard deductions. Keep those numbers handy, because knowing the right figures for 2024 can significantly save your clients money. In summary, getting filing status correct isn't just a technicality, it's a key part of tax strategy. Familiarizing yourself with these statuses will not only help you on the exam, but also enhance your practice as an enrolled agent. So, keep studying, and let's ace that exam together. Dependency exemptions and tests. Today, we're delving into the concept of dependency exemptions and the tests we use to determine who qualifies as a dependent. Now, let's start with the basics. Dependency exemptions are designed to reduce a taxpayer's taxable income by allowing them to claim qualifying individuals on their tax returns. This means if you can claim someone as a dependent, your taxable income is lower, which is obviously a good thing. But it's essential to understand the specifics surrounding who qualifies as a dependent, which is addressed in the Internal Revenue Code, specifically Section 152. There are 2 main categories, *qualifying children and *qualifying relatives. Let's break these down. To begin with, a qualifying child must meet several criteria. Firstly, they have to be related to you. This includes children, stepchildren, siblings, or even their descendants. Next, there's the age test. A qualifying child must be under age 19 at the end of the year or under 24 if they are a full-time student. Now, it's crucial to ensure that this child lived with you for more than half the year. This is known as the residency test. And lastly, for a child to qualify, they cannot have provided more than half of their own financial support during the year. Now, here's an important part. The financial support can be tricky because many people mistakenly believe that if a child has a part-time job, they won't qualify. But remember, it's all about who provides more than half of their support. Now let's shift gears to qualifying relatives. Instead of strict age requirements, qualifying relatives are determined based on income and support. The first test is the relationship test, which includes parents, grandparents, and even siblings. Here's an essential point. The relative must have gross income less than $12,700 for the tax year 2024 to qualify. Next, just like qualifying children, the taxpayer must provide more than half of the relative's support. People often trip up here, thinking any contribution qualifies, but it has to be that more than half threshold, which is a key point for enrolled agents to remember. Speaking of mistakes, one of the biggest pitfalls is misunderstanding the support tests. It can also be easy to mix up the different requirements for qualifying children versus qualifying relatives, so pay close attention to the details. In your role as an enrolled agent, you'll need to stay updated on IRS publications to help clients understand these rules properly. Advising clients accurately about who qualifies as a dependent can save them from making costly errors on their tax returns. So remember, as you prepare for your exam or work with clients, Keep these criteria fresh in your mind. Understanding dependency exemptions is not just about lowering tax liability, it's also about ensuring compliance with tax laws. Child tax credit, an additional child tax credit. Hello, everyone. Today, I want to talk to you about a really important tax benefit, the child tax credit and its companion, the additional child tax credit, sometimes referred to as ACTC. This is something that a lot of families benefit from each year, and understanding it is crucial for anyone preparing for the enrolled agent exam or working in tax preparation. So let's dive in. First off, the child tax credit is a way to reduce your tax bill if you have qualifying children. For the tax year 2024, the credit is $2,000 for each child under the age of 17. Now, you might be wondering what makes a child qualifying. To qualify, the child must be under 17 at the end of the tax year. They must be a dependent that you claim on your tax return, and they need to live with you for more than half of the year. It's an incentive to help families manage their expenses. Now here's the important part. The child tax credit begins to phase out depending on your income. For example, if you're a single filer and your income is over $200,000, you'll start to see a reduction in your credit. And if you're married filing jointly, it starts phasing out at $400,000. The credit decreases by 50 cents for every dollar you earn above these thresholds. So, high earners need to keep an eye on their income levels when filing. Then we have the additional child tax credit. This is a refundable credit. Why is that significant? It means that if your child tax credit exceeds your actual tax liability, you might still be able to get a refund. For 2024, up to $1,000 per child can be claimed for the ACTC, which can be especially helpful for lower-income families who pay little to no taxes but have qualifying children. Let's think about that for a second. Imagine a single mother who makes $180,000 a year. She qualifies for the full credit of $4,000 because her income is well below the threshold. But let's say a married couple makes $450,000. Because they earn over the threshold, they might only get $3,600 instead of a full $4,000. That can make a big difference come tax time. Now, while these credits provide valuable assistance, there are common pitfalls taxpayers fall into. One mistake is claiming children who don't meet the age or residency requirements, which can lead to an audit. Another common error is miscalculating income, especially adjusted gross income, when determining eligibility and how much credit they can claim. Also, don't overlook the ACTC. Many families may be eligible for that refund, but don't realize it. So, if you're preparing for the EA exam or working with clients, it's vital to stay updated on any changes in thresholds and requirements. You want to ensure that you're providing accurate and beneficial advice to your clients, helping them make the most of these credits. Understanding how all of this works is essential. Good luck and happy studying. Earned Income Tax Credit. Today, let's dive into a really important topic, the Earned Income Tax Credit, or EITC for short. This tax credit is a real game changer for low and moderate income families, especially those with children. Essentially, it's designed to lighten the tax load for working individuals, making it a pivotal component of the tax system aimed at reducing poverty. Now, let's think about what this means practically. Imagine a single mother, Jane, who works hard at her job earning $30,000 a year. Because Jane has 2 kids and her income meets the criteria set by the Internal Revenue Code Section 32, she qualifies for the EITC. For 2024, she can claim a credit up to $5,018, which can actually lead to a refund even beyond what she paid in taxes. Isn't that fantastic? This credit doesn't just reduce her tax bill, it can provide significant financial relief. Now, here's the important part. To qualify for the EITC, you must have a valid Social Security number and meet certain income thresholds. For instance, if you're a single filer with 1 child, you can earn up to about $25,300 and still qualify. If you're married filing jointly with 3 children, the limit jumps to around $55,000. So, checking those eligibility requirements is absolutely crucial. But it's easy to trip up on this. A common mistake people make is not filing a tax return at all. Many eligible folks might think they don't need to file because their income is low. However, If you don't file, you can't claim that EITC refund, which is definitely money left on the table. Other pitfalls include misreporting your income or neglecting the investment income limits. For 2024, that's capped at about $10,000. If you exceed that, you're out of luck for the EITC. As an enrolled agent, you'll need to be meticulous about validating your client's eligibility. They might come in with the right paperwork, but it's your responsibility to ensure they're fully eligible. Plus, staying updated on those income limits each year is crucial. You help your clients not only to save money, but to maximize their tax benefits. And remember, it's all about making tax preparation easier, clearer, and more beneficial for them. So, as you prepare for your exam, focus on understanding the details of the EITC. Learn about the thresholds, the qualifying children tests, and those common mistakes. Your knowledge could help a family like Jane's really thrive. And by regularly reviewing these figures, you'll be well prepared to guide your clients through their tax returns, helping them reclaim what they deserve. Education credits, American Opportunity Credit, and Lifetime Learning Credit. Let's talk about education credits, specifically the American Opportunity Credit and the Lifetime Learning Credit, both of which are outlined in Internal Revenue Code Section 25. These credits can significantly ease the financial burden of education for many families, and understanding them is essential for tax professionals. First, let's delve into the American Opportunity Credit, or AOC. This credit offers up to $2,500 for each eligible student, and it's available for the first 4 years of higher education. Now, here's the important part. The student must be pursuing a degree and be enrolled at least half-time for at least one academic term during the tax year. It's also important to note that there are income limits. If your modified adjusted gross income exceeds $80,000 for singles or $160,000 for joint filers, the credit starts to phase out. For example, let's say Sarah is a full-time college freshman whose tuition totals $5,000. She can claim the AOC for this amount, resulting in a reduced tax liability of up to $2,500, assuming her income is within the limits. That's a significant tax credit. Now, transitioning to the Lifetime Learning Credit, also known as LLC, this credit is available for any post-secondary education and doesn't require half-time enrollment. This means it's perfect for individuals who might be taking courses part-time. The Lifetime Credit allows for up to $2,000 per tax return, regardless of how many students are in the household. Like the AOC, the LLC also faces income limits that begin to phase out at the same thresholds. So, think about James, who works full-time and decides to take a couple of online courses. He pays $3,000.